Good afternoon, guys. Welcome, okay, to FOMC preparation. Okay, so very briefly, what we're going to do today is we're going to cover the FOMC from a very much a fundamental perspective. Okay, we're going to start off and we're just going to do a brief overview of the Fed. So Fed in a nutshell. Okay, what is Yellen thinking? What is the Fed thinking? What's their general idea going forward in terms of interest rates? Okay, we're going to have a look very briefly at the format of the meeting. All right, and then we're just going to talk very briefly about the Fed's mandate. All right, we're going to move on then to the previous meeting. We're going to have a look at what the statement said. What was the differences between the October statement and the December statement? We're going to have a look at Yellen's Q&A. So we're going to look at what did she point out? What did she tell us as participants that was important? Okay, and then we're just going to have a look at what the various market responses were to what Yellen was telling us. All right, then we're going to have a look at the previous data over the course of the last month. We're going to move on to the market pricing and expectations for the meeting. We're going to then have a look at the statement. We're going to bash down the statement a little bit. Look, where are the opportunities? Where can Yellen or the Fed actually surprise the market going forward? Okay, and then very briefly, we're going to have a look at some market structure. Okay, so first up, I'm going to move over to Imran, and he's going to do the Fed in a nutshell with you guys.
Hi, afternoon, guys. So this Fed's a bit different from the December meeting because we only have a statement released from them. There's no press conference, no Q&A. Fed meets every 6 weeks, but they only release a statement every 6 weeks, but there's only a press conference and a Q&A with Yellen every 3 months. So this is one of those occasions where we only get a statement. So during the release tomorrow, we'll get any decision on interest rates. Nothing is expected, but we'll get an announcement. We'll get an announcement, or have been getting announcements regarding QE and tapering. Against tapering's over, no QE is expected. But if anything were to come out, this is where it would come out. There will be no update of economic projections or dots. That comes with the release of a Q&A and a press conference with Yellen. So this meeting, in essence, is a pretty simple story. It's just a statement, nothing else. So this is a piece Brannigan just picked up, which I think summarizes it very well, what's been happening elsewhere. So what Fed hike? Essentially everywhere else, Bank of Japan has lowered its inflation forecast. Bank of England's hawks give up voting for a hike. So Bank of England went from 7.2 to 9.0 to vote in favor of rates unchanged. New Zealand CPI slows. ECB embarked on QE, and the Bank of Canada, as we see there, cut interest rates to 3/4 of a basis point. Sorry, 0.75% from 1%, which was unexpected. So there's been a lot of talk about Fed rate hikes. Everything else around it would suggest that the global economy is not doing so well. So this is more just a little pun, I think, and a little bit of humor maybe from that Brannigan picked up.
I think the important thing, guys, to note there, just to add in, is that, okay, if everywhere else in the world is taking the stance of low interest rates, accommodative monetary policy stance, the question is, can the US do this all on their own? Is the US going to be able to grow and create inflation and drive the world forward on its own? And that's the question, guys. If they can, brilliant, excellent. Okay, but if they can't, there's a lot of people that are particularly, we're going to go over that, particularly in the dollar space, that believe that the Fed are going to start hiking rates. Okay, but that's the question: is the Fed going to be able to sustain what we've seen over the last 12 months, or are they going to succumb to what everyone else is and move into a lower growth, low inflation environment? Okay. Okay, so let's move on. The previous meeting. Okay, we're going to very briefly go over the statement. In fact, if you can get that statement up, would you be able to move into the side? In fact, go down. I've got the statement. Okay, so very briefly, the highlights from the previous statement. Okay, the Fed was dovish on the PCE revisions. Okay, they were dovish on the Fed median forecast. In other words, they lowered their forecast of where they thought interest rates would be over the 2015, 2016, 2017 horizon. Okay, but very important, they downgraded that, but they brought it a lot closer to where the market was expecting rates to be. All right. Then they spoke again about lower energy prices giving a boost to growth. Okay, They dropped, or they didn't drop considerable time, okay, but they added in a word of patience. So they kept considerable time, but they said that the central bank would remain patient in normalizing rates. Okay, and then obviously they spoke about, when asked about rates going up sooner or later. Okay, again, they are data dependent, so they reiterate that they're waiting on the data. Okay, they can hike sooner than expected or later than expected based on the data. Then we went on to the conference. Very briefly, the highlight of the conference was right at the beginning when Yellen was asked to explain what she meant by a couple of meetings. Okay, she told the market a couple was at least, or that it means 2 meetings. Right, that was the crux of the meeting, because the whole market then thought that she was talking about the first potential rate hike as of the April 28th, 29th meeting. And that's important, guys, because everyone in the market is they're trying to figure out what is the Fed's thought on when they're going to start normalizing rates. The minute the market actually gets an idea, that's when they can start to price in potential rate hikes. That's when they can actually take on various bets with a little bit more certainty. Okay? But very important to note, what have we just seen? We saw a week and a half ago, 2 weeks ago, we saw the S&P come out and almost completely lose credibility by removing a floor. Okay? So central banks can lose credibility, and that's the important thing to note here. Okay? The Fed has almost gone out and told the market that potentially the first hike could come as soon as April. Right? So if suddenly now they start to deviate away from that, okay, there's a lot of people that are going to start losing faith in the Federal Reserve. Okay. Then Yellen said that they're probably very unlikely to repeat the same sequence we saw in 2004 to 2006, okay, where they hiked 25 basis points every single meeting. Okay, so they said they're unlikely to do that. She then went on and said that the forward guidance, in other words, the shift from patience, okay, and including the considerable time, was not a change in the intentions. And that's important, guys, because what she's trying to say is just because we added patience in, it doesn't mean we're any more hawkish or dovish than we previously were. Okay, so you must always listen out to the wording that the Fed members use. Okay, she then also said that markets fall inflation expectations again is likely to be transitory. Okay, they're reiterating this. All right, they're unlikely to start normalization for at least a couple of meetings. Asked about a lift off for 2015. Okay, Yellen said we're not committing. Okay, there's no preset time. All right. Very important one again. They'll want to have the confidence that inflation is getting back towards their 2% mandated target. Okay, that's a very important line there, guys, because effectively what that's saying is that the minute they're confident that inflation is actually going to move back to where they expect it to, that's when they'll normalize. Okay, so again, in reiterating how important inflation is. 15 of the 17 officials said they expected to raise rates in the coming year. Okay, so there's a strong consensus to hike this year. Okay, and we just heard one of the big major banks come out, JP Morgan, has said that they don't expect rates to get hiked until 2016. Okay, so again, it's this whole debate. Are the entire Fed wrong? In other words, these smart people that are on the Federal Reserve, are they all wrong, or is the market wrong? Okay. Another very important line. Yellen made a very important point to say that we don't have to have a press conference just to do something. Okay, and that's an important thing to make a note of, because most of your older generation that have been around for a long time, okay, will only know it that the Fed only acts when they have a press conference. Okay, so don't assume just because there's no press conference tomorrow that nothing can't happen. Okay, that's what Yellen was trying to say. They could hike rates, they could normalize policy even if there wasn't a conference. Okay, and again, the fall in oil is to be a net positive, so continuing to reiterate that there's going to be a positive spillover impact from oil, and then obviously the Russia impact is a lot smaller on the US than Europe. Okay, so again, make sure you have all these things, because from what Yellen has told us, from the statement, from talking to her and asking her questions, you're going to get a very good idea as to what is going to move the markets. Okay, what's going to make the Fed move going forward. Okay, then let's have a look at the market reaction. So initially, bang, statement comes out, right? The markets react. We had the downgrade to the interest rate forecast. So the very first thing and the most important thing is stirs. Okay, stirs led the drive up. They rallied quite hard as the market was almost a little bit disappointed, right, that the Fed had been very dovish on their interest rate outlook. Okay, so we had a very nice drive up in the stirs initially, and that dragged the back end of the curve with it. Okay, at the same time, the US equities, they would have gone a little bit on that, again, because rate hikes a little bit later, all right, and at the same time, the dollar would have taken a little bit of a knock on that. So we saw a little bit of a sell-off in the dollar initially, okay. Before Yellen even began, before she started talking, we had reversed all the moves, okay. So there was already very much a clue that the market wasn't happy, or that they hadn't thought that the statement was as dovish as initially it read, okay. Yellen then very early on in the conference spoke, and she said that a couple of meetings could be 2. Okay, and the market picked up on that straight away. It took it as extremely hawkish. Okay, we saw the stirs lead again to the downside, sell off very aggressively, dragging the 5s, 10s, 30s with it. Okay, we saw the dollar find a very strong bid on the back of that, and we then saw the US equities sell off, but then rally again into the close. Okay, so it's very important to go over that market reaction, because you're going to get a feel for not only what's moving the best based on the Fed, okay, but you're also going to get a feel for what's probably better to trade for US traders. Okay, as you can see, the way I've presented and the way I've spoken it to you, the best at the moment to trade is the stirs. Trade the interest rate products, okay, because they're the most sensitive to the Fed at the moment. All right, and then maybe look to the dollar, because the dollar is particularly sensitive to the Fed at the moment. All right, and then obviously maybe the equities, because they're a little bit less fundamentally driven based on what the Fed's doing. Okay, good. Are there any questions? Does anyone want to add anything? Do any of you guys pick up on something that maybe we've missed out that's worth adding in there? Okay, let's move on. Okay, so now that we've got an idea for what happened at the previous meeting, okay, and we've got a little bit of an overview of the Fed, we're now going to look at the data so that we as traders can look at and get a feel for exactly what the Fed's going to be looking at. So first up, NFP, January, okay. We had a little uptick, so we had 252,000 jobs created, good number on the headline. Okay, unemployment came down by 0.1, so good, but the stick out and the standout number, okay, was that earnings growth. Okay, as you can see there in the chart, it's the lowest number in earnings growth we've had since back to 1998, guys. Okay, so again, all the global central banks are talking about this wage growth concept. Okay, the fact that the US is creating all these jobs, and the fact that unemployment's coming down but wages aren't going up, is telling you 2 things. It's telling you the jobs that are being created, 1, aren't very good jobs. Okay, they're very temporary in nature, but they're also low-paying type jobs. Okay, but also 2, it's telling you that there's obviously potentially a lot more slack in the economy. Okay, and that's a problem, guys. If there's too much slack in the economy, right, how are we going to start getting inflation going back towards the 2% target? Okay, so get your head around that. Very important piece of data. Okay, so we then move on to the PMI manufacturing, non-manufacturing. Okay, both were misses to the downside. Okay, so manufacturing looking like it's starting to slow again, the steam coming out of it. Okay, we saw that for both services and non-services. The CPI numbers, okay, again, both missed to the downside. All right. Whilst the Fed expects this, they expect it to be transitory. Okay, again, we have to ask, is this the start of a new trend? Okay, is the US going to go the same direction as the UK went? Okay, where inflation is going to keep going lower and lower and further away from that 2%? That's what you need to be asking yourself. In terms of retail sales, okay, it was the December period. We should see a very, very strong retail sales, if not a beat in the retail sales. Okay, yet we got a very, very low number, negative number. Okay, and then the inflation expectation, so the 5-year tips. Now, what's the market expectation of inflation 5 years from now? Okay, if you look at the chart, and you can go down very briefly, you'll see since the previous meeting, those expectations have not risen. If anything, they're even further lower. Okay, they are stabilizing, but they're lower. So the market doesn't believe that we're going to create inflation down the line. Okay, and at the end of the day, that's what drives the market, guys. Inflation expectation is what's driving bond yields to these low compressed levels. Okay, good. And as you can see there, that's your inflation expectation. So you can see since July last year, the middle of last year, all we've seen is a very strong downtrend in the market's expectation of inflation. Okay, in order to get the market to start believing in this, we're going to need something. We're going to need some wage growth. We're going to need some evidence from the data. Okay, I'm going to move over to, oh, just very briefly, sorry, it wasn't JP Morgan. As you can see there, Morgan Stanley pushed back there, forecast for the first Fed hike. Okay, one of the big banks. All right.
Okay, guys, so Brannigan went through very quickly what happened last time. So now we're at what's going to happen now, where we're at now. So where I always like to start is market pricing, and I'm looking at interest rate markets. The STIRs, like Brannigan said, short-dated interest rate products, are the ones that give you the clue as to what the market is pricing. They generally lead the market. They tell us where the market believes rates will be, and give us a barometer to compare with against where the Fed expects it to be, interest rates to be at year-end 2015, 2016, 2017. Now the Fed last time round released their dot plot. Now it's just an estimate from each Fed official, but it's a gauge. These guys are paid a lot of money to sit on the board and essentially determine interest rate policy for the US. So if we look what the market's thinking relative to what the Fed are thinking at the moment. Before I do that though, the current Fed funds rate is within a band of 0 to 0.25%. So currently it's at 12 basis points, but that's a floating band. So when we get to the upper end of the band, it will be 25 basis points. And when I talk about rate hikes that might be priced, it will be from that 25 basis point starting point. Okay, so the market is actually pricing the first hike in 2016. Now, Brannigan just mentioned that at the last meeting, 15 of the 17 Fed officials actually predicted a rate hike in 2015. So the market is thinking something very different to what the Fed are thinking. Now, like I say, it's hard to predict into the future. Yellen has consistently said their projections are just that, they're projections. But we're in 2015 now, so the nearer projections are likely to be more solid and more robust from the Fed than, say, the 2017 projections. So for the market to be pricing up a rate hike in 2016, the first rate hike in 2016, but the Fed to be calling for essentially most of them, a strong majority calling for 2015 rate hikes, is quite a discrepancy. And you can see this by what the market is actually pricing for year end. So the market currently, via the Fed Fund futures, is pricing a yield of 52 basis points at year end. So that's essentially one rate hike from where we are now. The Fed's median dot plot, 1.125%. So that's almost 2 whole hikes behind that the market are in relation to the Fed. DEC 2016, similar story. 2.5% is the median dot forecast. Market at 119. And DEC 17, which is very airy-fairy, so I don't really pay too much attention to that. But median Fed forecast, 3.625%. Market 1.7%. So what can we see from this? Right. Essentially, the market is pricing a later lift on in rates than the Fed and a much slower pace. So if you look at the numbers, the market's pricing one rate hike in 2015. The Fed are essentially pricing in 3 to 4. The market in 2016 is pricing in 3 rate hikes. The Fed is pricing in 5. Assuming we go in 25 basis point increments. Historically, the Fed move in 25 basis point increments. And in 2017, which, like I said, I don't pay too much attention to, but the market is pricing in 2 rate hikes, whereas the Fed are essentially pricing in 4 rate hikes. So essentially, as I said, the market is pricing a later lift-off and a much slower pace. And that's reflected by the flatness of the yield curve that we see. Brannigan has a chart, I think, that he will bring up later. So, and just for context, why the market generally, why we generally talk about 25 basis point increments is the last Fed hiking cycle, they did just that. From 2004 to 2006, they hiked 17 times in a row in 25 basis point increments. Now, Brannigan talked about the language a little bit earlier. The Fed have said they're patient in raising rates. That's what they said last time. At that time, when they were hiking, I think it was Greenspan that was the head of the Federal Reserve. He talked about measured pace, inverted commas, measured pace. And measured pace to him meant 25 basis point increments at every single meeting. So basically, to sum up with this, the market and the Fed are in two very different places. Something's got to give somewhere. And this is why, you know, although there's no update to projections, although there's no press conference, if essentially the same thing gets reiterated again, the market may need to readjust. And that's something we can talk about a bit more tomorrow when we go through the actual trading of it. So has anyone got any questions on that?
Okay. Guys, just one thing to point out, again, we're going to talk a little bit more about this in terms of when we get to the trade structure. But don't forget, when you have a discrepancy where a market is pricing one way and the Fed is pricing another way, eventually one of them's got to give way. One of them's got to be wrong. Okay, either the Fed's going to lose credibility and they're going to say, you know what, actually things aren't as hunky-dory as we think, and you know, we're probably not going to hike rates till 2016. You're right, market. We're going to get a correction. Okay, you're going to get the dollar absolutely getting hammered. You're going to get bond market movement. You're going to get equity movement. Okay, the equities will be so relieved that, oh, you know what, actually the Fed's not going to do anything for another year. Okay, but equally, if the Fed comes out and says, you know what, hang on guys, you're wrong. Okay, this oil impact is going to add 0.5% to inflation in the next 2-3 months. You're wrong. Okay, then the markets are going to move aggressively. So you guys need to get excited. This discrepancy has been here for 6, 7, 8 months now. But eventually something's got to give way. And that is, remember I tell you guys about your 10 golden opportunities as a trader. That will be that day, that golden opportunity day, where you, if you know what you're doing and you understand this huge variance between the Fed and the market, that's the day you make quadruple, 5 digits, 6 digits, 7 digits, whatever you want to make. Okay, so get excited about this, guys. This is important, understanding this pricing.
This is extremely important, and this is why I always start with this, because the thing is, if the Fed do deliver on what they kind of project, the market will have a hell of a reaction based on where it is now. But can anyone really complain the Fed have shafted them? No, not really. The Fed have told them all along what they think, and the market's just been well away from it. And I know there will be so many traders out there, if they don't make money out of this, and they'll be like, why didn't I just listen? So we're prepping for this. Don't be surprised if they just keep reiterating the same thing and the market realigns. By the same token, don't be surprised if the Fed change their projections to reflect what the market is thinking. But I think the bigger opportunity will be if the Fed follow through, because the market is so far away from that. But we'll talk about this a bit more tomorrow. So moving on, what we're going to go through now is some of the things to look into in the statement, and call it statement science. So what at the Federal Reserve, they target two things: inflation and employment. We probably should have mentioned that a little bit earlier. So in the statement, there are a number of things I will look to, but they will be my focus initially. I've mentioned them down here: assessment on inflation and assessment on employment. But before that, Brannigan touched upon the word patient remaining in the statement. That is expected. Now, last time, as Brannigan said, Yellen referred to, you know, when she was asked about being patient, it was referred to as a couple of meetings rather. Now we're one meeting on. Will patient still be there in the same context? If patient is still a couple of meetings, then that could actually be interpreted as actually we're pushing it one meeting further. So this is just something to think about, which I think not a lot of market participants have thought about. They're very much clued on that patient word, but to mean two meetings. But now we're at that first meeting. So maybe will there be an elaboration of the patient language? Maybe, what is expected, that the whole reference to considerable time will be dropped. And that could be important as well. It's kind of expected. Last time it was left in just because Yellen didn't want to scare the market by dropping it completely. This time I expect it to be dropped. The market expects it to be dropped. If it's not dropped, that's probably a dovish scenario. Brannigan generally likes to talk about things in terms of hawkish, dovish, neutral. That would definitely be dovish if considerable time wasn't dropped, in my view. Or if patient was just left there in the same context as we won't move for at least 2 meetings. But is it dovish enough relative to market pricing? Probably not, given that discrepancy we've seen. Okay, so secondly, assessment on inflation, and I link with that oil prices. So the last statement, we saw they expect inflation to rise gradually towards 2% as the transitory effects of lower energy prices and other factors dissipate. Now, I think this is key to watch, because we've seen that, as Brannigan said when he went through the data, inflation has dropped. Inflation expectations through the 5-year tips have dropped. If you look at the 5-year forward, they've actually dropped 20 basis points since the last meeting. Bond yields are a lot lower, so the market is expecting lower inflation, but the Fed will always talk about core inflation mattering to them, and that's where oil prices and the effects of energy prices feed in, because the Fed are only bothered about the medium-term inflation outlook, and they don't really look at the short-term effects of lower energy prices. So this statement is key. If they have some sort of line saying they expect inflation to rise less gradually or slower than expected to 2%, or the transitory effects of low energy prices not to dissipate, or something like that, then that, in my view, will be a dovish scenario. By the same token, they could just reiterate this, and the market might take it as hawkish, because again, we're one step closer to that 2-month period, or that 2-meeting period. And since the last meeting, oil, we haven't seen a bounce back in oil.
$10 lower, and I'll show you the chart. We're $10 lower since the last meeting.
Okay, that's great. So $10 lower since the last meeting. But it's also important to know how the Fed weigh this up. They've generally said that it's going to be a good thing going forward, but how long will it take to feed in? 1 month, 3 months, 6 months, 9 months, 12 months, 2 years, 3 years? Does it buy them a little bit more time? Do they really want to hike rates at a time where inflation currently is pretty low and not looking like getting towards 2% anytime quick? Okay, thirdly, employment. So that's the thing that's probably been most stellar and most pleasing for the Fed over the last year and a half. Payrolls has been strong, unemployment rate's been going down, and hence why they've generally had in their statement that underutilization of labor resources continues to diminish. And I expect that to be reiterated. Now, Brannigan touched upon the wage growth being a bit of a miss, quite a big miss actually, lowest since 1998. But having said that, there were a few banks that came out straight after that and said that it could be down to some measurement error, changes in the way they measure it. So that's probably why you didn't see the market react with a huge rally in bonds, a huge rally in STIRs on that day, because there is a bit of uncertainty about that. But that will be something to look out for, definitely, if they address this issue of wage growth as a concern. And again, if we go hawkish, dovish, neutral, that's going to be on the dovish side. But remember, generally they've been very hawkish on the employment side, and that hasn't been the issue for the Fed. It's always been about inflation for them, because the employment has long met their mandate. They were talking about 6.5% unemployment rate as being what they were what they targeted, the threshold, and that was met over a year ago now. So it really is inflation that's lagging. Next, the assessment on growth. Again, and that links in with oil prices as well. How long, generally, the Fed have talked about oil being a positive on growth in the long term. How long will that take? We get GDP figures out at the end of this week. So I don't really expect too much to be changed on growth before those figures. Nothing in my view will really affect an upgrade or downgrade to growth. And the global outlook. So as we touched upon at the start, the US is in a very different situation to everywhere else in the world, as in it's doing pretty well. We've had a a little bit of weak data in the last month, but in general, the US has been doing pretty well. We saw, like we said, we saw Canada cut rates, New Zealand's been struggling, but the ECB embarking on QE, how will the Fed interpret that? Sure, Europe is in trouble, but the Fed will be, in my view, be very happy that the ECB have injected stimulus into the economy, because ultimately Europe is a big trading partner of the US. It's a big driver of global growth, and essentially the ECB is kickstarting part of the global economy for the Fed, and that would be a concern to the Fed. If the global economy, the Fed can't persist, the US economy can't persist just on its own without the help of other countries, its trade partners, without global growth motoring along, and that will be very encouraging to the Fed. Now, will something on it come up in the statement? I personally don't think so. I think we'll probably hear about some talk of the effects of the stimulus in the minutes, but again, if it comes up in the statement, be ready and prepared for it, because it will be something new. It's not like inflation where we have a line. It's not like employment where we have a line. So that's something we should consider, and in my view, they will see it as a good thing. So that for me would be on the hawkish side. So I think Brannigan will speak a little bit about the dollar impact now, and a few other things he's got to talk about.
Okay, so very important, just right at the beginning, with this language statement, and this is what you guys as traders have to do tonight before tomorrow's part 2. Okay, you need to have, very basic, a hawkish column, a dovish column, a neutral column. And you need to outline in your head exactly what would be hawkish for you, dovish or neutral. Okay? If the Fed comes out tomorrow and they, in their statement in a red headline, state that the dollar is too strong based on the recovery of the US, okay, that is a no-brainer trade. But if you do not plan for that, if you do not prep it based on what the market outcome is going to be, okay, you're going to be like a rabbit in the headlights. You're going to make some money. If you don't make money, you shouldn't be trading. You're going to make some money, but you're not going to maximize. And that's why we go and we do the statement analysis. So we write down all the potential scenarios, all the potential changes, and how we're going to respond to that. Okay, so very briefly, I'm going to talk about the dollar impact, but I'm going to do that and I'm going to get the chart. The last section, okay, is just obviously now the market structures. I'm not going to go through trade strategy with you, okay, but what I am going to show you is I'm going to show you a few charts. And from that, visually, I think all of you are going to smile and you're going to go, okay, I know what I want to trade tomorrow. Okay, the whole purpose of the market structure is to go and find that market that just needs unleashing. There's so much power and energy in that market, it just needs that kick. Okay, and that FOMC could be the kick tomorrow. And that's where you get the big opportunities over the FOMC. Okay, so if you can just, I've got the charts up there. Just scroll them one by one for me. Okay, that's the 5. Yeah, I'm going to have to go to the... Okay, let's start with the dollar. Yeah. Okay. Do you want to shut those lights off, please? And we can just have a brief look at these charts. Okay, so as you can see, the dollar index, okay, remember, dollar index very heavily weighted the euro. Okay, it is 70% weighted in the euro. So a lot of what you'll see here is because of the euro, but equally, the dollar has appreciated across the board, to the euro, to the yen, to the everything. Okay, now, since the previous meeting, you can see we've appreciated by a further 6.2%. Now the Fed knows this, guys. They speak about this. Okay, the dollar, it's nothing wrong with the dollar appreciating, but the speed at which it appreciates is a concern. Okay, 2 reasons. Remember, the whole world borrows in dollars. Okay, the whole world has still got a lot of money borrowed in against the dollar. Okay, so if that whole world starts paying back now, every month it costs them 6.2% more to pay back those dollars. Okay. So over the long run, there's a lot of talk about the emerging markets. How are they going to respond if this dollar keeps appreciating at the rate that it's appreciating? Okay. Very briefly, why is the dollar appreciating? Well, it's simple. They're the only ones that are meant to hike rates this year, whilst every other central bank, Canada, Japan, Europe, okay, they're all cutting interest rates and adding to the easing bias. Okay, so it's almost a case of that divergence between central banks. Okay. So the important thing to note there is, what's the long position, or what's the net position of this market? Okay, very, very long. Fundamentally, there's only longs in this market. Okay, so we know that. We keep that in the back of our head as traders, because if we know that, then we know where the potential trade opportunity will come. Okay, you can just go to the next one for me. Okay, so yeah, our first market. Okay, ding ding ding, Japanese yen. Okay, what's the direction of the yen? Anyone? Okay. Is there anyone, that thinks the yen should appreciate? Okay. That's what the entire market thinks right now. Okay, the yen is a one-way bet. Everyone is short yen against the dollar. Okay, so why have I shown you this? Well, very simply, you can see there we've got some resistance up at the top there. Okay, and now we've got some 1, 2, 3. Very strong support. Okay, and just remember this is the US dollar yen. Okay, but as you can see, over the last 3 weeks, what have we done? We've started to lock up a little bit of energy. The market's in a sideways market. It's waiting to break either to the upside or to the downside. And again, we've also got an inside week. So there is some very clear, obvious structure. If the Fed comes out tomorrow and they say something dovish about inflation, about employment, okay, you want to be looking to potentially trade the yen. Why? Because there's very obvious structure in the yen. If it takes out that inside day and can get below that little point, okay, we could have the longs start to liquidate. Okay, good. Next chart. Okay, what have we got here? So why have I put up the, what have I put up here? Okay, why have I put the euro up? Okay, again, structure, so we can compare. In the yen, we had some very obvious structure. In the euro, do we have obvious structure here? Yeah. Do we? No. Is there structure in this market? No, there is no structure. Okay, the simple is no, it isn't. Okay, if they came out and the dollar started to sell off, okay, what are we going to encounter all the way up the page? Sell side action. Okay, so again, yes, whilst this is a one-way bet and everyone is obviously short the euro at the moment because of the diverging monetary policy, okay, is this as easy a structure as what we've seen in the yen? And the simple answer is no. Okay, of course the euro can rally, but what you have to ask yourself as short-term traders is, will it rally as easily as the yen? Okay, and that's the whole purpose of structure. That's why we look across the market and see where's going to be the easiest opportunity. Next one. Okay. I actually want to go to the pound, but it's fine. We can come back to that. Let's see if we can. There we go. Okay, so again, very briefly, the pound, just showing you the structure. Is it an obvious structure? Okay, again, probably not as straightforward as the yen. Not to say you can't trade the euro or the yen or the pound. You can trade any one. Okay, but US traders need to go and determine what's going to give you the easiest opportunity. Okay, let's move on. If you can go back one for me to the stirs. Okay, so very quickly, let's have a look at this is the DEC 15s. Okay, the reason I wanted to show you this is because if you look down here, what we've seen over the last month, okay, that's the flattening occurring in between the DEC 15s and the DEC 16s. Okay, so what that's telling you is that the market is currently, they're keeping their interest rate or their forecast on when they're going to start hiking. They're keeping that to somewhere between the middle of this year and the back end of this year. But what they're doing is further down the line, they're actually starting to say, well, we're not going to hike as aggressively, as Imran said. Okay, so they may lift off this year, but once they lift off, it's not going to be, as Greenspan said, it's not going to be every single month for 25 basis points, but it's rather going to be maybe on ad hoc. Once a year, maybe 3, 4, 5 months, 6 months down the line, a second one. Okay, so this flattening is important to know because, again, if the Fed keeps coming out with this dovish rhetoric, all right, and they keep disappointing on inflation, we should continue to see this flattening type bias. But again, we know that the whole market is in this flattening type bias. The entire market's playing for this flattening trade. So if the Fed were to come out with something hawkish, if they were to come out with maybe an estimate of what oil could do to inflation, okay, then obviously we'll need to get an unwind. We need to get some steepener trades going in. Okay, and just very important, since the last meeting, I don't know why it's not in here, but since the last meeting, I think we were somewhere around, yeah. Okay, so as you can see, obviously the DEC 15s are high, in other words, yields are lower. So the market again is pushing out that first rate hike further and further down the line. Okay. Okay, so what have I got here? So we're going to have a look at the oil and the gold very briefly. Okay, again, gold as a structure. I want to show you just a little bit of a short-term play here. Okay, what have we got since the beginning of the year in gold? Okay, guys, very, very strong uptrend in the gold. Okay, so what have we formed now over the last couple of days? Okay, a little bit of a flag forming. All right, as you can see, we've had 2 days of consolidation, But again, if they disappoint, if we see some dollar weakness, okay, structurally, this market looks very good for a continued move up. So gold could be potentially the market you want to be trading tomorrow. Okay. Once we get through that previous resistance point, if the dollar is selling off because the Fed's dovish, okay, then maybe we actually get an easy 10, 15, 20 buck move in the gold. Okay, again, looking at the structure. All right, next market. Okay, last two markets, guys. I think we got oil. Okay, very briefly, what's the structure in oil? Okay, bit of a one-way trade. Okay, so we have a look at, over the course of today, we've seen the dollar weakening a little bit, but what's happened to the oil? Okay, failing to bounce. Okay, so we're sitting in this little 51s to 44 range. Okay, obviously that's the last time 55 bucks we were at the previous FOMC. So again, guys, if you're trading the oil, okay, we've got some good structure to the downside in oil at the moment. Okay, just last thing. Okay, and for those that love to trade the S&P, okay, again, also very important, notice how we start with sort of the dollar, maybe move on to the bonds, and then have a look at the equities. And we do that simply because equities are fundamentally the most difficult to trade. Okay, but as you can see, same in the equities, you've got a little bit of structure here, guys. We're stuck in a sideways pattern. Okay, we have been stuck in the sideways pattern for a few weeks now. So maybe if they come out dovish, if they push back those forecasts of a rate hike, maybe that gives the S&P the kick to the upside. But equally, if they come out and they're very, very dovish and the S&P cannot hold a bid, okay, what is that telling you about the nature of the market? It's telling you that actually it's technically very weak. Okay, and then the last two charts I've got will just be the 5-year and the 10-year. Okay, so very briefly, that was the October 15th, the flash crash in the bond markets. Okay, so yeah, you've got the US 10-year, as you can see, it's trading 1.28%. Okay, we have taken out that low, and again, we are sitting below that low. So the market's interpretation of future inflation is very, very low at the moment. Okay, as you can see. And then obviously the last one, which is a little bit more interest rate sensitive. Okay. I think the previous one was the 5-year. Okay, maybe I just copied. No, that was, yeah. Okay, maybe I just copied two. Don't worry about it. Okay, so lights on, please. Okay, so with the market structure, I'm not going to give you my trade idea. I'm not going to give you my trade plan. But what you as traders need to go away and do now is you need to assess, am I going to trade the dollar product? Am I going to trade the equities? Or am I going to trade the bond markets? If so, which part of the bond markets am I going to trade? Is it worth trading the 30-year or the 10-year? Okay, what part of the statement are you going to hit maybe the stirs on or the dollar? And that's what you as traders need to go and do today, so that tomorrow when we come back, we will then go through the trade plan for the FOMC. Okay.
Just to add to that, guys, so today's been essentially the easy stuff, the stuff that we know, stuff that we can plan for. Let's all have our plans ready for tomorrow. I will give you a couple of ideas I've got. Brannigan will give a couple of ideas he's got. And at Futex, we have a very good sharing culture. So we want you to come with some of your ideas and we can discuss them. There might be things me and Brannigan haven't thought about that might be more than valid. There might be things in the statement that you're looking for that might be tradable that we haven't touched upon. But this is why, this is just essentially whetting your appetite for what might come tomorrow. But there might be other things as well, and it's important that you all do your own prep, and I will continue to do my prep because this is just a basic overview, and it's important because we can make money out of this stuff. So this is why we've done this 2 days early, or a day, well, more than 24 hours before the meeting, because we feel that we'll have some time to assess, formulate our trade plans. We'll come in tomorrow, clear-minded, and share with you our ideas, and you'll do the same. Like Brannigan said, there are so many different products you can trade, but it's about you finding the product that suits you, the structure that suits you, the market you're comfortable with trading. You don't just have to trade stirs to make money. You don't have to just trade bonds to make money. You don't have to just trade the S&P. You can trade any one of these products, but it's about you finding your way of doing things, and different traders will find their own way, and that's what we're going to try and do tomorrow. We'll go through a few different trade plans and trade setups.
Okay, any questions? Awesome. Do you want to add anything? Great. Have a good evening.
Cheers.